Trading in the Wild West of Finance, that's over-the-counter, or OTC, trading on pocket option, and today we're diving deep into whether you should venture into these uncharted waters. First, what exactly is OTC? Unlike regular markets with set hours, OTC assets trade directly between parties, often outside of normal exchange hours. On pocket option, this means you can potentially trade 24/7, even on weekends. See the OTC label next to the asset. That's your indicator. One huge advantage is availability. You're not limited by standard market schedules. If opportunity knocks at 3 a.m., OTC is there. Plus, sometimes you can find unique assets not available on major exchanges, potentially leading to higher payouts. But here's the catch: OTC markets are less regulated, meaning higher volatility and increased risk of price manipulation. Liquidity can also be lower, making it harder to enter and exit trades quickly at your desired price. Due diligence is key. Before trading OTC, thoroughly analyze the asset's historical data, if available, and use technical indicators to identify potential trends. Don't rely solely on gut feeling. Implement strict risk management. Use stop-loss orders to limit potential losses and take profit orders to secure your gains. Only risk what you can afford to lose, especially when dealing with volatile OTC assets. So, should you trade OTC on pocket option? If you're a seasoned trader with a high risk tolerance and a solid understanding of market analysis, OTC can offer exciting opportunities. However, if you're new to trading or prefer a more regulated environment, it's wise to proceed with extreme caution, or perhaps stick to traditional markets until you're more comfortable. Remember, knowledge is power in the trading world.